Good afternoon, dear students, and welcome to Agrawal Vidya Vihar Digital Classroom. I, Professor Shaurya Shah, welcome you once again to the lecture of Advanced Accounting and Auditing Paper 6 TYBCom Semester 5. I hope each and everyone is well and fine at your place. Dear students, in the last lecture, we had studied about the syllabus of TYBCom Accountancy Paper 6. We had studied various chapters, that is your theory chapter, management accounting, ratio analysis, cash flow, and fund flow statement. I told you in the last lecture that we will start first with the chapter of ratio analysis. Again, the chapter is very easy. Students, you just need to remember certain formulas and remember the concepts. On that basis, your sums will be solved off. A 14-mark sum generally comes from this chapter for sure. Apart from that, short sums also comes of various ratios. We will see in detail what are ratios all about and what is the chapter of ratio analysis. Shall we begin? Now, starting the chapter of ratio analysis, once we start computing the sums, before that, you need to understand what is ratio and what are the formulas that are to be used, how those formulas are made, and how you can use that formulas. So first of all, starting with the meaning of ratio analysis. What do you mean by ratio? Ratio is a relation between two related items of financial statements, that is known as ratio. Now I can say it in common language. And what do you mean by ratio? In everyday life, we compare ourselves or we compare anything with some other similar thing. We can say you have scored 70% marks, another person has scored 80% marks. I can say my marks or my weight is two times the weight of that person. Or in other way, I can say our ratio is 1 is to 2. So what is actually a ratio all about? It is a relation between two related items of financial statements. Now, when we are into the management accounting, everything related to financial statements we need to calculate. A ratio is thus one number expressed in terms of another, right? It is just a number which can be expressed in terms of another. So again, seeing it in detail, how is ratio expressed? As I told you, a ratio can be expressed in three main forms. The first is as a percentage, second is as a proportion, and the third as a pure number or times. Very simple example, students, you all must be understanding it. The very first thing, as percentage, such as 25% or 50%. For example, if net profit is 25,000 rupees and the sales is 1 lakh rupees, then the net profit can be said to be 25% of sales, as sales is 100% and the profit is 25,000. Second part is as proportion. The above figures may be expressed in terms of proportion also. I can say profit to sales is 1 is to 4% because 25% is 1/4 of total part. Third is as pure number or times. The same can also be expressed in an alternatively way, such as sale is 4 times of net profit or profit is 1/4 of the sales. All this in crux remains one and the same, just the measure of expression is different from one another. Ultimately, the answer remains the same. So whenever we will solving the sums, this three type of things will be given in your sum, students. Many a times it will be said that closing stock is 1/4 of sales, closing stock is 1/4 of purchase. Many a times always profit will be given in percentage, 25% of sales, 50% of sales, 60% of sales. So in that terms we will be calculating it. But before going to sums, understanding the theory and the formulas are important. Fine. I hope it is clear to everyone. Now starting with the main part of the chapter. Again, students, the theory part is also there. There are two main answers: advantages of ratio analysis and disadvantages. That is your limitations of ratio analysis. Again and again it is asked in your TY BCom examination. Theory part, I will take it complete separately once the chapter is completed. I'll also provide you the notes for the same in Google Classroom. You can download it and you can read it. Once the theory formulas and everything is completed, then I'll give you the notes. Now, classification of ratio. Ratios can be broadly classified into four main groups. The first amongst that is liquidity ratio or solvency ratio. Second is profitability ratio. Third is activity ratio or turnover ratio. And the fourth is capital structure or leverage ratio, right? So all these four ratios which you are having will be having again sub heads in it. These are main four heads in which we can again classify the ratios. Moving ahead, this table shows you the classification of entire ratio. Whatever type of 12, 13, 15 ratios we are having can be classified into these three heads. The first among that is balance sheet ratio. These are generally the financial ratios which are related to the particular of balance sheet. Now in that, first is current ratio. We will see each and every ratio in detail, students, with all examples and formula. Just understanding, current ratio is the ratio of current assets and current liability. All the things here you can see are related to your balance sheets. Quick asset, again a part of current asset only. Proprietary ratio, related to your owner's fund, liabilities and assets. Debt equity ratio, again related to the debt and the liabilities of the balance sheet. So all four main ratios are related to your finance, that is balance sheet, financial statements. Second is your P&L ratio, or we can say income revenue statement ratio. So in that, operating ratio, as you all know, you have very well studied trading account and profit and loss account. So from that trading account and profit and loss account, you calculate the following ratios. In that, the first is gross profit ratio. It is the ratio of gross profit and sales. Second is operating ratio. Operating ratio is a ratio related to operating expenses and sales. Third, expense ratio. Then you have net profit ratio and stock turnover ratio. As such, we are going to see each and every ratio in detail with formula and with their advantages. Fine. So we will see it in detail. The next is again balance sheet and profit and loss ratio. Now, when you will refer your reference book, there are three types of heading given. The first as such balance sheet. Third is P&L or revenue, we can say. And the third is your second, I can say P&L and revenue. The third I can say is your composite ratio. It is a mixture of balance sheet and your profit and loss, right? So it is also known as composite ratio. Here, fixed assets turnover ratio, that is a ratio of fixed asset and sales. Second is your return on total resources ratio, return on own funds, earning per share, debtors turnover ratio. So all those things are a composite of your assets and a composite of your P&L, or again we can say trading item. I hope it is clear. So this is a broad classification which we are going to study. In addition, there are 3 to 4 more ratios. We will see one by one. Understanding the formulas is very, very important, and then you need to remember it so that we can solve the sums very, very quickly. Okay, to begin with, the very first is your liquidity ratio. I hope each and everyone is clear, very clear with the classification. Now starting with the liquidity ratios. As you can see, the name itself says liquidity. So these ratios analyze the short-term financial position of a firm, indicate the ability of the firm to meet its short-term commitments out of its short-term resources. So liquidity basically is related to your current assets and current liability. As you all know, current assets are those assets which are less than 12 months for a shorter period of time. Current liabilities are the liabilities which you need to pay more than 12 months. Is it correct? No, less than 12 months, right? So again, more than that is a long-term asset. So current assets and current liabilities are limited to a time period of 12 months. Two examples are there: current ratio and liquidity ratio, or quick ratio or acid test ratio, right? So all three names for a single ratio. We will see one by one. This is known as solvency ratio, right? Students just start noting down one by one formulas, because at the end of the lecture I have prepared sums for you people. You need to calculate those sums and you need to tell me the answer for that, right? So just start preparing the list of formulas. Again, I'll be providing after all the formulas are completed in, again we can say, next lecture. So I will provide you the PDF for all the list of formulas. But before that, we need to solve the sum. So current ratio. What is current ratio? As I told you, current assets upon current liabilities. Conventionally, a current ratio of 2 is to 1 is considered to be ideal. What do you mean by 2 is to 1? If current assets are 2, then current liabilities are half, that is 1. Remember students, it is an ideal ratio. Every business cannot have it. It varies from industry to industry and business to business. In your Tybcom syllabus, you don't need any ideal ratio to compute, right? You just need to tell the answer, you need to calculate it, and no comparison is to be done. Fine. Clear with the current ratio? Moving ahead, what do you include in current assets? Most important thing. When you will be having a long sum, you will be given n number of particulars in that. From that particulars, you need to calculate and you need to identify which assets to be taken and which assets are not to be taken. Right? If a single particular mistake is there, your entire ratio will get changed. So current asset. In current asset, the very first thing is inventories of raw material. So inventories of raw material, you include work in progress. You also include your WIP. Second is your finished goods, right? So finished goods are also a stock of goods, the closing stock we commonly know it as. Then you have stores and spares. That is spare parts you have. Then sundry debtors, receivables, short-term loans, deposit and advances, cash in hand and bank, easy I suppose. Prepaid expenses, any expenses paid in advance. Then you have income receivables and marketable investments and short-term security. So all this lists you need to remember that what is included in current assets. Similarly, you need to calculate current liabilities. So current liabilities include sundry creditors, bills payable, as you all knowing. You are studying since first year BCom, second year BCom. Outstanding expenses, unclaimed dividend, that is important, you need to remember in sums. Many a times it is asked. Advances received. Then there is income received in advance. Next is provision for taxation. Then proposed dividend, installments of loans payable within 12 months. Then you have bank overdraft and cash credit, right? So all this students you need to remember in current liabilities, current assets. I hope it is clear. Current liabilities, it is clear. So your current ratio is automatically clear. Current assets upon current liability into 100 gives you your current ratio. If not 100, then it will give you into 2 is to 1 or 1 is to 2, whatever the case is. Next ratio is your quick ratio or acid test ratio. This is a ratio between current assets and current liabilities, alternatively known as quick liabilities. Now, quick, much more quicker than your current assets also. So what do you do in that? In your quick ratio, you remove stock also, because you must be knowing if you are having a closing stock in your business, in order to sell those closing stock, you need some time to convert it into liquidity, that is money. So quick itself says remove stock, inventory, other things remains in that only. Is it clear? Current liability is same as your quick liabilities. Conventionally, a quick ratio is of 1 is to 1 is considered to be idle, right? So 1 is to 1 you are having, if it is there, then it is considered to be idle, right? But it is not again compulsory that it should be 1 is to 1 only. Fine. Moving ahead, quick assets are current assets less prepaid expenses and inventories. Generally, the stock is to be cancelled and prepaid expenses, if any. Suppose prepaid rent is given, or if any asset is to be prepaid, then it is removed. Quick liabilities are current liabilities less bank overdraft and incomes received in advance, right? So you need to remember these two things. Quick assets are your assets less prepaid expenses and inventories. Quick liabilities are current liabilities less bank overdraft and incomes received in advance. I hope it is clear. So current asset, current liabilities, current assets less stock, less prepaid expenses gives you quick asset. Current liabilities less bank overdraft and income received in advance gives you quick liabilities. So quick asset upon quick liabilities gives you quick ratio. Is it clear? Or we can say acid ratio. Next is profitability ratio. Now, in your first thing, that is liquidity ratio. Now we are having only 4 heads to be studied. First head we have completed, that is your liquidity or solvency ratio. I hope every student must be clear with that. Second head is your profitability ratio. Now this ratios measures the operating efficiency of the firm and its ability to ensure adequate returns to its shareholder. Right? What do you mean by profit? Every business unit is established to earn profit. You must be agreeing, and developed on that basis, this ratios gives the idea about the progress of the company. Every stakeholder, maybe it shareholders, maybe it creditors, maybe it debenture holders, maybe the owners of the company, are interested in profitability. So what is the relation of profitability to sales? How much we are selling, how much we are earning. Second is profitability in relation to investment. Suppose today if I say I sold 10 lakh rupees of goods and I earned 1 lakh rupees profit. So my profit will be 10%. Perfectly correct. Now when I am selling, suppose I say in relation to investment. So when I invest 2 lakh rupees, I am earning 10,000 of profit. So compared to investment, my profit is 5%. Compared to sales, my profit is 10%. So all those things you need to calculate. So profitability ratio. Which are the profitability ratio? Mainly divided into 4. The first is your gross profit ratio. Second is your operating profit ratio. Third is your net profit ratio. And the fourth is your expenses ratio. So we'll see one by one. Very easy ratios, students. The very first is your gross profit ratio. This ratio is calculated by dividing the gross profit by sales. It is expressed as a percentage. Gross profit is a result of relationship between prices, sales volume and cost, right? GP. GP comes under trading account, right? We used to write down sales on the credit side. We used to write down closing stock on the credit side, opening on the debit, purchase on the debit, expenses on the debit. We deduct all the manufacturing expenses, opening stock. Then at the last we were getting GP, that is gross profit, right? So this gross profit is always compared by sales. So that is why GP upon net sales into 100. Always remember it is in percentage. I hope it is clear, students. So GP ratio is the first profitability ratio. So far we have seen current assets, we have seen quick, that is your current ratio, we have seen quick ratio, then we have seen GP ratio, and the next is your net profit ratio. Net profit, as you all know, we are getting it from your profit and loss account. So this ratio is indicative of firm's ability to leave a margin of reasonable compensation to the owners for providing the capital. After you are calculating GP ratio, you deduct all the expenses, admin expenses, selling expenses, office expenses from the profit and loss account. You deduct all the losses. But after meeting all those charges and cost of borrowed funds, you pay interest, you pay financial charges, then whatever is remaining is your net profit after interest and tax. Again, tax is to be paid to government. So most important thing, many students makes mistake in that. It is always remember NPAT, net profit after interest and tax. Generally, we know it as PBIT and PAT. PBIT is profit before interest and tax, and PAT is profit after tax. So profit after tax divided by net sales into 100. Net sales includes your sales less your sales return. So this will give you the idea of net profit ratio. Next is your students operating profit ratio. Now what is operating profit ratio? Again, the most important, every sum, whatever each ratio we are discussing consists of 2 marks. Suppose in sum it is said calculate current ratio, then it is of 2 marks. Calculate net profit ratio, 2 marks. Calculate GP ratio, 2 marks. So in all, 14 marks sum will have 8 to 9 computations that you need to do. If you are clear with the formula, clear with the concept, the sums are very easy. Is it clear? Okay. Now it is a ratio showing relationship between cost of goods sold plus operating expenses and net sales. It is a ratio which shows relationship between cost of goods sold plus operating expenses and net sales. Here operating expenses means very much important to remember admin expenses, sales expenses, employee benefit expenses, and depreciation on assets. So what is operating expenses? All those things which comes on the debit side of P&L account, that is admin expenses, selling expenses, employees benefit, that is salary, depreciation on assets. So all those things are included. That comprises of your operating expenses. Financial expenses like interest on borrowed capital are not included in operating expenses. Mind well, students, this many a times students make mistake. They take interest also. But financial is not a operating expense. It is specifically said that operating expenses is related only to the operations of business. That is why it is not included. Remember the formula of operating ratio, students? Cost of goods sold plus operating expenses into 100 divided by net sales, right? So operating expenses we have seen just now. Okay, what is the operating expenses all about? Second is your cost of goods sold. Opening stock plus net purchases plus purchase expenses minus closing stock. That is your COGS. You generally know it as. COGS is opening plus purchase expenses minus closing stock. Or vice versa, many a times in sums, this all things will not be given. They will give you only net sales and GP. So what you will do? Net sales minus gross profit is cost of goods sold. Alternatively, if GP is missing, then you will do net sales minus COGS is equals to gross profit. If sales is missing, net sales is equals to COGS plus GP. So single formula gives you all the solutions. I hope it is clear, students. Fine. So far we have seen current ratio, quick ratio, then we have seen GP ratio, then we have seen net profit ratio, and now operating ratio. Now, if you are clear with the operating ratio concept, right, then you need to again solve this sum. It is very easy. I give you 1 minute to read this sum and understand the concepts. Then we'll start once again. Please read it, what is given and how you will solve it. Okay, students, I hope you must have read the sum and understood too. What is given in the sum? They have given you purchases, they have given you opening stock, they have given you purchase expenses, they have given you closing stock, admin expenses, and selling expenses. You should take only 1 minute to solve this sum. If you are clear with the formula, you can easily solve it. What is it? If anyone can quickly find out the answer for it, how we are going to solve it? First, for operating ratio, you need three things. The very first is your operating expenses. Now here, operating expenses you need to calculate. Which two expenses are given in the sum? Very clearly, admin expense and selling expense. So this will form part of your operating expenses. Fine. Now the next thing is, you are being given to find out cost of goods sold. Cost of goods sold, just now we saw, that is your purchases, then you have to calculate opening stock, then you need to calculate purchase expenses and closing stock. So what you will do? Opening stock plus purchase expenses minus closing stock. That will give you cost of goods sold. Fine. So we'll be settling down in our formula. Operating ratio is equals to cost of goods sold plus operating expenses divided by your net sales. Is it clear, everyone? Fine. So what you will do now is to calculate. Please check your answer if you have got it or not. Admin expense plus selling expense, that is 98,000 plus 22,000 gives you 1,20,000. Operating ratio, that is cost of goods sold plus operating expenses into 100 divided by net sales. Net sales is 5 lakh rupees. Suppose it is there in the sum. Okay, net sales is missing in the sum. Fine. Okay. just calculate it according to the formula, then just check the solution for it. Okay, I suppose everyone is clear with this formula. Fine, moving ahead. Now at the end of every lecture, you have to test your learning, whether you have understood it very clearly or not. Fine. So what you will do, which of the following is not included in liquidity ratio? Right. Every question, I have a set of questions for you people. As it is theory, I have given you theory. Then from next lecture onwards, you need to solve the sum and I will provide you the answer. Okay. Which of the following is not included in liquidity ratio? Current ratio, liquid ratio, debt equity ratio, and quick ratio. Must be knowing the answer. Current ratio we saw just now, liquid ratio we saw just now, quick ratio we saw just now, debt equity ratio. Right? So answer is debt equity ratio. I hope you must be knowing it. Then the next, this is for you people to calculate it. Calculate net profit ratio if the GP is 67,500, COGS is 1,01,250, and net profit before 50% tax is 33,750. Calculate it very precisely. NP ratio, right? So what you need to calculate NP ratio. What is the formula of NP ratio? Net profit after interest and tax divided by net sales into 100. So here it is given, you have been given cost of goods sold and GP is given. So I gave you one formula to calculate cost of goods sold plus GP is equals to sales. So when you will calculate, you will get from GP and cost of goods sold the sales. Once you get the sales, you need to calculate the profit. NP is 33,750 before 50% tax. So what you need to do is you need to divide it by 50%. So you will get half the amount for your net profit, right? Find it out. If you can get the answer, I'll give you 30 seconds. Okay, students, you must have got the answer. 10% is the correct answer. If you have got it, you have understood it very clearly. Those who have not got it, again check the formula. Please again practice the sum. This kind of sums will be asked in 2 marks or 3 marks in your final examination. If you are clear with the formula, your sums will be very easy. Okay, one more. While calculating liquid ratio, which one of the following is not considered? Liquid ratio is the second ratio which we saw. Bank overdraft, do you consider it? Yes. Stock in trade? Yes. Debtors? Yes. Bills receivable? Yes. So everything is yes? No. What is the correct answer? That is B. Stock in trade. We do not consider stock in trade, prepaid expenses, pre-received income, and we do not consider the bank overdraft. I suppose everyone is clear with the question. Fine. So we have studied today 5 type of ratios: current ratio, quick ratio, GP ratio, NP ratio, operating expenses ratio. So on the basis of that, we have seen the formulas also. What you need to do, students, is to write down the list of formulas, revise it, and from the next lecture, we will see another set of 2 heads ratios. This was your liquidity ratio and profitability ratio. Again, we will be seeing other 2 heads, proprietary ratios and all, in the next lecture. And from the next lecture itself, we will start with the long sums. We will be practicing it together. I'll be giving you the sums very well in advance a day before in Google Classroom so that you can prepare your questions accordingly. I suppose everyone must have understood the thing. If any query, you can post it in Google Classroom and we will be definitely here to help you out clearing your query. This was Assistant Professor Shaurya Shah in Accountancy, teaching you Advanced Accounting and Auditing 6. Thank you very much for paying the attention. Have a good day, students. Best of luck. Thank you.